And as Kathleen just told us, even though maybe not in a voting capacity, Bullard, of course, is a thought leader at the Federal Reserve, and we are barreling towards the July meeting. And Liz Ann, to your point, there's a lot of unanimity on the Fed board right now. We haven't seen dissents necessarily under Powell that had maybe been expected. When it comes to the July meeting, it seems like that's pretty much seen as a lock. But what's your best guess on where we go from there, especially after the data that we've gotten in the past few weeks?
Well, tell me what the data is going to look like between now and the September FOMC meeting. The Fed continually emphasizes data dependency, so trying to gauge what they're going to do at a meeting 2 months from now, I think, is tricky. What's interesting is the probabilities based on Fed fund futures, as I mentioned, are over 90% for a 25 basis point hike at the July meeting. And let's assume that happens. If you look at expectations for the September meeting, it's more than 80% likelihood that the Fed doesn't do anything in September. But if these easier inflation conditions are one-off in the sense that you maybe get a surprise move on the upside, if only because of base effects, and you continue to see relatively warm numbers or hot numbers in terms of the recent decline we saw in claims, I think that could move the needle in terms of expectations for the September meeting, because there's a lot of time between now and then, a lot of data both on the inflation front and the labor market front.
We've been having a lot of debates here off camera, Liz Ann, kind of about the idea that maybe the Fed won't be as important for the market in the way that it was, of course, during the big bull market cycle when they kept rates at basically near zero, and then over the last couple of years as they ratcheted up rates to 5% here. Is there a sense here that with their job maybe potentially done, that the market can then, I guess, decide to obsess over something else rather than what Jay Powell, Jim Bullard, and the rest of the cohorts are saying?
Well, I guess it depends on if the market goes back to pricing in a pivot. I think the Fed has finally done a somewhat successful job in getting the market to understand that pause and pivot are not the same thing, and the conditions for an actual pivot to rate cuts just don't exist. Even if we were to persist in this disinflationary trend, I think what Powell and most others on the Fed want to try to avoid are the fits and starts that occurred under Burns in the 1970s of declaring victory and not just staying at whatever the terminal rate was each time, but easing policy only to see inflation come out of the bag again. And that's ultimately what led to Volcker having to pull a Volcker, as we now like to say. So I think it's that pause era that, assuming the market does adjust to the fact that higher for longer is likely what the Fed is telegraphing. But if the market starts to price in cuts and the Fed digs their heels in, that could be a potential risk. I just don't see that as imminent.
Well, besides what the swaps market is pricing and what the bond market is pricing, let's talk about what the equity market is pricing in, because we're looking at a pretty robust risk asset rally in the past couple of months, of course, building on the start to the year. Is that pricing in cuts, or what is being priced into the equity market at this point?
So I'm not so sure cuts are priced in, but a pause sooner rather than later. I think also what the market is pricing in is a better earnings outlook, and at least the hope that second quarter earnings end up looking like first quarter earnings, which is the bar gets set too low, companies beat expectations, and you have this sense of a firm bottom in earnings, even if the acceleration is not significant. Therein lies a bit of a risk, because what happened in the first half of this year, which, by the way, was the complete mirror image of what happened in the first half of last year. First half of last year, you obviously had the beginning of a pretty ugly bear market. Interestingly, though, it was all multiple contraction because earnings were growing in the first half of last year. Fast forward to the first half of this year, the rally has been all multiple expansion without any benefit accruing from E. And in addition, we've had very strong nominal revenue growth, but we now have no real revenue growth. Revenues are in negative territory in real terms. And I think it's always an interesting question to talk about the bond market versus the stock market, because I think the bond market tends to live in the real world. I don't mean that generically. I mean specific to real interest rates, real economic data, where I think the stock market tends to focus more, live more in the nominal world. And we may be now at a pretty important inflection point because of that differential, especially in something like nominal revenue growth still strong, but real revenues in negative territory.